Hey, good evening, good morning, everyone. Welcome to our Phillip Securities Research morning call for today. We have a few stock counter updates as well as results, video on the ground and site visit on Wilma. For technical analysis, we have the S&P 500, and also we'll round it out with the Singapore REITs Monthly as well as Singapore Weekly. So this is our usual disclaimer: the information provided is solely for educational purposes and should not be considered as financial advice. So without further ado, I'll hand over time to Helena to get us started on C Limited.
So I'll be presenting on C. We think our performance is likely to continue, but their valuations are pretty stretched already. So their first quarter 25 revenue and PATMI were in line with our expectation. Next slide, please. It was a 30% year-on-year growth, primarily driven by strength in Shopee, which grew 29% year-on-year, and Money, which is previously known as C Money, increased 58% year-on-year. So their first quarter 25 revenue and PATMI were at 23 and 25% of our FY25 estimate. So it's an all-rounder growth in all the three segments. Their Shopee's growth, strong momentum, 29% year-on-year in revenue and 22% year-on-year growth in GMV. This is supported by favorable seasonality because Ramadan this year, it falls entirely in Q1. And also they've been gradually increasing their take rate. Their take rate increased 50 BPS year-on-year. The platform has turned profitable. Last year, it was suffering a loss of $0.02 billion US dollar. Unit economics have significantly improved. This is driven by their ongoing scale expansion and cost optimization effort. They also have stronger monetization. This is particularly driven by advertising, which even though it's a small single-digit share of their total revenue, it grew by 50% year-on-year. So management did note that they see minimum macroeconomic impact due to very limited exposure to cross-border trade. Right now, the retail spending in Indonesia is pretty resilient. And also its positioning as a price leader platform may help boost penetration in difficult times because more cost-conscious consumers, they will try to increasingly turn to platform in search for a better value. So Money, which is formerly known as C Money, it sustained its strong momentum. It increased 58% year-on-year, the fastest growth rate in the last 2 years. Its loan book increased 77%. This has supported a very solid expansion in its user base. So this quarter, they actually have 4 million new first-time borrowers. So they do have a strategic push in markets like Malaysia, Thailand, and Brazil. We think this growth is pretty healthy, especially if you take a look at their non-performing loan ratio, which even declined from 1.2% last quarter to 1.1% last quarter. So this is considered very, very low. And this is partially because they have very extensive data ecosystem coming from Shopee. So it would be pretty easy for them to have a better credit rating of the customers. We project Money to grow around 35% year-on-year in FY25. Last but not least would be their gaming. So the gaming rally continues. We see a surge of booking, which increased 51% year-on-year. Both QAU, QPU have healthy growth as well. So this surge benefited from seasonality as well because several holidays, including Ramadan, falls entirely in the first quarter. So gaming has actually been seeing a very positive trend for more than a year. But the strength, there's a delayed effect, so it wasn't really reflecting in the revenue. So this quarter, we see an 8% year-on-year growth. So it is a positive trend that we do see it beginning to materialize. And we do expect revenue growth of around 17% for the entire year. Moving on to their outlook, they haven't really changed much. They're still guiding for mid-20s GMV growth in FY25. We think overall C presents a pretty compelling long-term investment opportunity. It has dominant position in all the three segments: e-commerce, digital finance, and gaming. It's still continuously churning very high revenue growth and profitability. But in the short term, because it was a very significant rally in their stock price, their stock price increased 35% since the last quarter. So the stock trades right now at a forward PE ratio of around 54x, which is very high compared to its peers like Amazon, which is only 36x. So this kind of reflects elevated investor expectation. So we do see minimum upside at this price level. In terms of recommendation, we downgrade our recommendation from accumulate to neutral due to the recent share price rally. We have raised our FY25 revenue and PATMI by 2% and 13% respectively to reflect the robust growth in Money and gaming, and also the continued improvement in cost efficiency. We also increase our terminal growth rate because we think we do see the long-term growth potential of their finance sector because substantially they're really just penetrating a very large bank population in Southeast Asia. So overall, we raised our DCF target price to $160. That's all from me. I'll pass my time to Miao.
Thanks, Helena. Yeah, so SATS released the FY25 result last week. Next slide, please. And so the results are in line with our expectation. Gateway service revenue rose by 11% year-on-year to 4.5 billion, and this was primarily driven by a 15% year-on-year increase in air cargo volume. And we do expect front-loading momentum to continue into first quarter 26. Where order cancellation from Chinese e-commerce player following the removal of the de minimis exemption has already occurred, but demand has been backfilled by the rising demand of automotive parts. However, we are still penciling in a 3% year-on-year decline in FY26 gateway service revenue, as front-loading is expected to taper off from second quarter 26 onwards, which the company is likely with companies likely to adopting a wait-and-see approach to their inventory restocking. And another positivity for SATS is we do see EBITDA margin is improving, so it increased by 0.9% year-on-year to 17.4% in FY25, and this is well on track to reach the aspirational 2029 target of 20%. And this is essentially due to improving operating leverage as the business volume improves, so revenue growth is outpacing cost increment. And we do believe our margin will continue to be resilient in FY26, which is 2025, as SATS is able to pass on the inflationary pressure, such as manpower cost, to its customers. So manpower usually accounts for 50% of the total cost. And something negative is the meals served in the non-aviation segment declined by 0.7% year-on-year, as one of the Central Kitchen in China, in Kunshan, was shut down for consolidation with Tianjin Central Kitchen. So sales was disrupted for like a quarter. However, we expect the growth in 2026, FY26, to be driven by the food solution segment, with revenue improving by at least 7% year-on-year, supported by the rising demand for fresh and frozen products in China and also Southeast Asia. And for outlook, around 5% of the group's revenue is actually exposed to Chinese e-commerce export to the US, so we expect demand to taper off following the cancellation of the de minimis exemption. And with a flat fee of $100 per parcel, this is very likely to impact the lower value items, which tend to higher price elasticity of demand. So SATS also see growing demand of the route from China to Europe, from China to Middle East, and also from China to Africa. With its very strong cargo station network and also commercial contract pipeline, SATS is well positioned to backfill of the volume loss of the US e-commerce related demand by other regions. And as for the US dollar depreciation, SATS doesn't expect any material impact from that on profitability, as they do employ a natural hedging policy where revenue and costs are largely in US dollar. And they also did internal structure changes were implemented to minimize the intercompany translation losses. But we do lower the target price from 4.62 to 3.58, considering the fading tailwind of e-commerce. But we maintain a buy recommendation for SATS, and assuming a payout ratio remain unchanged at 30%, we forecast a FY26 dividend DPS of 4.7 cents. The next slide, please. Yeah, so this is a Phillip on the ground for Yangzijiang Shipbuilding. We don't cover the stock, so it's non-rated. So Yangzijiang achieved first quarter 25 order win of 0.3 billion, and the target of US 6 billion target order win remain unchanged. And the new Hongyuan yard, which is scheduled for its first delivery in 2027, will increase capacity by 17%. And another project, Runze Yard project, has been suspended due to the muted market demand. And Yangzijiang also clarified that the 6 billion target is actually more of their internal KPI, which is planned according to their capacity, rather than a reflection of the current market demand, like demand supply situation. Yeah, so currently they don't see any customer canceling their orders, and the shipyard is still running at full capacity. So FY25 revenue is expected to be flattish compared to 2024. And some updates on the two defaulted LNG carrier, which is still under their inventory of RMB 1 billion, and they have not yet recognized the revenue. So Yangzijiang is considering to list them out upon completion by 2025, if the price is not promising. Yeah, but they have yet to put it onto the market, yet to sell it. And on the cost front, there's no major change in steel or labor cost, as all the steel required for 2025 delivery has already been purchased. So we do expect cost to be similar to FY24 level. And for the US tariff and USTR related uncertainty, although we do see them like ease slightly compared to what happened in April, it still remain like highly uncertain compared to the pre-tariff period. Yeah, so for outlook, Yangzijiang emphasized like ship owner is taking a wait and see approach due to the market uncertainty, as USTR is still undergoing the second hearing. So market demand remain muted, and Yangzijiang doesn't expect any significant new orders in 2025. And if ship owner does want to place orders, a Korean shipyard is likely to be the priority to be prioritized due to their earlier available delivery slot, which is like typically 1 year ahead of Yangzijiang's delivery slot. Yeah, so Yangzijiang only has limited availability for smaller vessels for 2028. Yeah, so even though like Korean shipyards has increased their price, yeah, but ship owners still prefers Korean shipyards instead of like Chinese shipyards. So Yangzijiang is trading at dividend yield of 5.8%, and their dividend policy remain unchanged. So they'll distribute 30 to 40% of their PATMI. Yeah, that's all for Yangzijiang. Yeah, I'll move on to Velma International, which is a Phillip on the ground. Yeah, so this is a set visit note. We don't cover Walmart. Yeah, so we visited Walmart's headquarters, R&D center, and also central kitchen and factories in Shanghai, Hangzhou, and Kunshan, China. So the management noted that F&B sector has faced headwinds post-COVID, with consumers becoming more price sensitive. And so since YKA, which is Walmart's China subsidiary, mainly offers stable food products, so the shift towards like down trading has limited impact on its profitability. So, and also the recent US tariff action had little impact on its subsidiary, since like more than 90%, more than 95% of the sales are domestic. And also, even though like there is impact on the importing of soya bean, but Walmart is confident that they can source the raw material elsewhere. So instead of like purchasing from North America, they can turn to South America for purchases, and the price and quality is similar to North America. Yeah, so here's a photo of their strategic partnership. So basically, YKA supplies raw materials to all the well-known fast food chains in China. Yeah, next slide, please. So we also visited their experiential center. So they do have a wide variety of consumer products. So this is demonstrating their effort to diversify into the downstream market. And also in response to Chinese consumers' growing preferences for healthier lifestyle, YKA is also introducing more functional products, such as the cholesterol-lowering soya milk, and also the high DHA oil, which is the photo on the right corner. Yeah, so this is marketed for its weight management and also reduced daily oil intake. Yeah, and the selling price for the box is around like 400 RMB. Yeah, with margin usually for the functional products is typically over 100, and for the DHA oil is more than 400 or 300. Yeah, if I remember correctly. So they are mainly targeting towards the health conscious and also like premium tier consumers with very strong purchasing power. Yeah, next slide, please. Wilmar is also scaling up its central kitchen concept by renting out some excess space to F&B, excess space of their like warehouse and factories to F&B companies, and also like cross-selling some of the products downstream. So with the increasing demand for the ready-to-eat meals, Wilmar plans to launch three more new factories, three more new sets in 2025 with capex of around like 2 billion for each central kitchen. Yeah, 2 billion RMB for each central kitchen. But it still like varies according to its scale and also like cities. Yeah, so this will bring into a total of like 9 food parks for Walmart, and this is and they will become the largest player in the market by scale. So taking the Tianjin Central Kitchen as an example, Wilmar will retain around like 30% of the space for their own operation. Yeah, so they will produce something like the ready-to-eat products, such as the photo on the left corner. Yeah, so here are some examples of their ready-to-eat products. And some of them supplies to 7-Eleven, and majority supplies to supermarkets. Yeah, so the remaining 70% of the occupancy will be leased out to other F&B companies, such as KFC or McDonald's. Yeah, so tenant will be charged based on monthly rental, and Wilmar will also supply them with the raw materials such as oils and also like flour. And the business model aims to reduce packaging and also transportation cost for both Walmart and also their clients. And the typical lease contract is around 5 years, with 3% rental escalation for every 2 years. Yeah, so the contract tenure is usually like longer than the typical Chinese leasing contract, which is usually around like 1 years. Yeah, that's all for me. I'll hand over to Aben for
Thanks.
Centurion. Thank you.
Thanks, Mel. I'll present on Centurion's first quarter 2025 update. So they released this update with revenue figures and some key figures. So their revenue is within our expectations, and there's a 13% year-on-year growth in revenue because of higher rental reversions in Singapore worker accommodations. Yeah, for those who don't know, Centurion is a company that does worker accommodations and student accommodations. And for their positives wise, from the latest data released by MOM, it shows higher demand from work permit holders. There's around a 3 to 4% growth year-on-year. And Centurion also has a strong upcoming assets pipeline, as can be seen in the table on the bottom table on the left. So, for example, a key worker accommodations coming up is the Westside Mandai worker accommodations with 3,700 beds. So that is roughly about 10% of their current Singapore bed capacity, and it is still for completion in FY 2026. And another key project is also their Sydney student accommodations with around 732 beds. So this makes up about 82% of their current Australia student accommodation beds, which is slated for completion in the fourth quarter of this year. So for the negative for Centurion, in this quarter itself, for Australian student accommodations, it experienced a negative 7.4% year-on-year change. And this is because there's some student visa delays. However, the delays are being resolved and the occupancy for Australian student accommodations is back to 93%. So this is this is back to roughly normal levels of 90+%. So for our outlook for Centurion itself, we do see that because there is a higher demand for Singapore worker accommodations, we do think that this will continue to sustain the higher rental reversions for Centurion itself. And shortage still persists in Australia's student accommodation. So we do see the occupancy maintaining at these levels for the rest of the year. And the pipeline of assets listed over here should contribute to FY 2026 revenue and PATMI itself. For our core itself, we maintain and accumulate for Centurion, and we raise our target price from 1.4. We raise our target price to 1.45 by raising our EV/EBITDA assumption to 9.2x to reflect the strong asset pipeline upcoming. Yeah. Next slide, please. I'll present on BRC Asia's first half 2025 results also. Next slide, please. Yeah, so for BRC Asia, for those who are unsure, they are a company that provides steel products for construction sector. So for BRC Asia itself, their first half 2025 revenue and PATMI are within our expectations, and their second quarter revenue actually increased 2%. So as you can see in the table on the left itself, even though revenue for the half yearly basis dropped by about 5.6%, if we look in terms of quarterly basis for the second quarter 2025, it increased by 2% because of the increase in steel volumes itself. We estimate this increase to be about 19%. And just an update for BRC Asia, their order book is being maintained at the record $1.5 billion that they had in the previous quarter. For positive wise, this is the first positive revenue year-on-year increase since first quarter 2024, as can be seen on the chart in the bottom left-hand corner. The dark blue color bars represent the revenue itself. The light blue color line represents the year-on-year change for revenue. For the price itself, for the red color line itself, it represents the steel prices itself. As can be seen, the steel prices greatly affects the kind of revenue change that BRC Asia has. So for the latest quarter itself, in second quarter 2025, even though price dropped by about 14% year-on-year, revenue is able to increase by 2% year-on-year, and this is because there is an increase in volume of steel being delivered. For the negative of BRC Asia, as mentioned earlier, the persistent low steel prices continue to weigh down on revenue. Yeah. So as for our outlook on BRC Asia wise, Singapore's construction industry remains vibrant because as we know, Terminal 5 just broke ground this month. So this means that physical construction will officially start taking place. And we believe that BRC Asia, having a 65% market share in steel, it will greatly benefit from this uptick in construction. There's also other projects ongoing within the construction industry, such as HDB, BTO flats, IR expansion, as well as the industrial facilities development. So we do expect volume expansion to drive revenue growth of about 9% year-on-year for FY 2025 itself. As for our outlook on steel prices, China's property sector still remains weak. So we do think that steel prices can still continue to fall. As for our comment on how will low steel prices affect BRC Asia, it will continue to weigh down on revenue. However, because steel is a raw material for BRC Asia, this lower cost of raw material will actually expand BRC Asia's profit margins, as can be seen in the profit performance in first half itself. Because of these lower steel prices, BRC Asia actually have lower finance costs, and this lets them have a higher profits itself. For our call on BRC Asia, we maintain accumulate, and we raise our target price to 3.4 by lowering our WACC to 11% because of the visibility of orders. Yeah, so I think all in all, low steel prices is like a double-edged sword. It will weigh down on revenue. However, because it is also a raw material for BRC Asia, so low steel prices will enable BRC Asia to have a higher profit margins as well. Yeah, so that's all from my end. I'll hand over the time to Dane. Thanks.
Thanks, Itwan. Good morning, everyone. I'll move on to the technicals. Yeah, so first out, looking at S&P 500, last week the rebound met some resistance at the 5,970 level. So currently is also trading under some of the short-term moving averages, the blue line as well as the red line in the chart, which is the 5 and 10-day moving averages. So I think this week we could see some further pullback here to fill the price gap, possibly at 5,700 level. So as for the current resistance is at 5,880 to 5,970 area. Support is likely to be at 5,585 to 5,700 area. Yeah, so going into more detail about the S&P 500, we think that the current relief rally has hit into a bit of resistance. So looking at the chart, the 5,970 level, it represents a retest of this uptrend channel breakdown in blue, and it also is also confirmed with a previous range consolidation support breakdown at the end of February. So this represents quite a strong resistance. So we could see a pullback from this level, and with the RSI retracing from the overbought level of 70, we could see the index pull back closer to the support level, closer to 5,500. And if it fails to hold, then the next support level is likely to be at 5,120. Now, looking in terms of the other chart, which is the volatility index VIX, it also supports the view that S&P 500 we could see a pullback in terms of the S&P. So yeah, the VIX has retraced towards this upward support line again since the highs on 7 April, and currently is also breaking above this the short-term moving average, short-term 5 and 10-day moving averages, the red line as well as the blue line. So we could see an uptick in terms of the VIX towards the next two resistance levels at 28.3 as well as 35, which could represent some downside for the S&P 500. So all in all, we have a technical sell for the Vanguard S&P 500 ETF VOO at a sell price of $535.77. Take profit levels at $502 and $469. Stop loss at $562, and last close on Friday was $532.40. So that's all from me. I'll hand over time to Paul to talk about Singtel results.
Yeah, thanks, Zane. So for Singtel release their second half results, the highlight is the giving pledge, because in terms of ordinary dividends, their payout is 80%. They're giving out special dividends, and now they're doing share buyback. I mean, that's the reason for the title. Next slide. Okay, so for the results is within our expectations. Revenue 97 and profit about 99%. The highlight operationally was the strength in Optus Mobile. A bit hard to see, sorry, but if you look at the third line there, you can notice that the mobile business actually was up 4%. And unlike what's happening in Singapore, the mobile pricing officially raising prices, because I think and they're also raising prices not to just the consumers but also to the MVNOs, which are those operators that do not have a telco like Circle Life. I think something like what you see here in Singapore, they have the equivalent of a Circle Life in Australia. The other reason for operation has been the strength in Bharti. So Bharti is the mobile operator in India. There are only 3, or I guess 2.5 or 3 operators in India. So if you look at the results on the left, the red box, you notice that Bharti's earnings was up about 48%. So again, similar to what's happening in Australia, I think the reason why earnings is strong is because mobile prices are actually rising. But the negative, on the flip side, what we have is actually mobile competition starting to bite in Singapore. I think this is also highlighted by StarHub that there's a hyper competition. So initially, Singtel is a bit more immune, but this time around, you're starting to see the mobile revenue start to decline. I think this is the first decline, I think at least in 3 years that they're starting to see this type of declines. And what Singtel is trying to do is maybe move up to focus on the higher price plans, which is through network slicing. That means, like for companies, you can get priority speed, and also you can get better security. Our accumulated recommendation maintain, we raise our target price. So when it comes to valuing Singtel, there's actually 2 parts. So one part is the valuation of all their associates, which are largely listed. The main one is Bharti Airtel, which is listed, and then you have Telkomsel in Indonesia, which is not listed, but you have Advanced AIS, which is also listed in Thailand, and another group. So when we reduce our discount, we usually put a 20% discount, because share price are volatile, right? So, but now we bring it down to 15 because they are starting to monetize more and more of Bharti Airtel. And their second part of the business, about 20% of the valuations come from the subsidiaries, which is Optus, Singtel, NCS, and their data center business. So Singtel has two large parts in terms of the sum of parts in terms of valuations. So in terms of the outlook, the reason the share price ran is because they announced asset recycling target. Basically, another way of saying they're going to sell more stuff. So they're going to raise from 6 billion to 9 billion. So far, they've achieved 4 billion. They sold Phillip the Singtel Com Center, whereby they were jointly developed and they secured proceeds of about 1.3 billion. Then the rest have been Bharti. And part of the proceeds they're going to use is to do a share buyback of 2 billion over the next 3 years. So what else are they going to sell? So we think they're going to sell the Gulf development, which used to be In Touch. So there's about 2 billion. This used to be an associate, but now it's only an investment. So you don't really get any earnings from it, and you're only just going to get dividends. So I think it's only logical that Singtel is going to dispose this. The other one is, of course, the big one is Bharti Airtel. So Bharti Airtel right now is about 50% of their valuations. Of our 440, half of it is actually Bharti Airtel. But what they're going to do is they're going to equalize the stake. So what they want to do is to equalize. So the current partner in India, which is Bharti Enterprise, has about 22% stake, and Singtel about 28%. So they want to equalize. So both parties want to have like equivalent share. So if you do the math, so roughly Singtel can sell another 3%, which is about 5 billion. That's why we maintain a buy. But a word of caution, because ultimately Singtel's share price is going to be very linked to where Bharti Airtel share price is going to be, with half the valuations, and now most of the market now cutting back the discount to the so-called discount to associates from 20% to some 10%. So there's going to be a bit more volatility on Singtel share price. At this juncture, I think we have a buy, but if you look at the dividend yield, even with the special dividend, you're looking at about 5% yield. If you compare that to the banks, of course, it still pales in comparison. Next slide. So I'll go on to the usual weekly. So there wasn't much macro news. There was a bit of China, but I didn't want to showcase that because we don't want to focus too much. But in China, basically the data point that we got was that the property sales is still quite big. But in terms of our tactical views, our weekly strategy, so it's here we go again. So of course, Donald Trump is raising the tariff risk again on the markets. So they announced 50% on EU. I think he changed the deadline from 1st June to I think 9 July, if I'm not mistaken. And he also threatened 25% tariffs on Apple and Samsung smartphones by end June if they do not show more efforts to make the manufacturing out of the US. One positive is that the Treasury Secretary Besson said that unlike Europe, the negotiations with Asia is moving forward, and they probably want to make some announcements the next 2-3 weeks. So there's again the usual. There's going to be a lot of volatility of the news. Probably the next 1-2 weeks he'll announce some deals with maybe Korea, Japan, and some ASEAN countries. We hope, and maybe they will kind of push the market up a bit. Then of course, got all this risk again. The other thing, he commented that he wants the semiconductor supply chain in the US. So this is going to raise the risk premium on all exporters. The threat of tariffs by Trump. Of course, those on the Singapore stock market, the most exposed would be the glove manufacturers and semiconductor makers. So that's why we are a bit more cautious on the SGX semiconductor names, because you are always open to any threats or I guess tweets by Trump that he's going to tariff semiconductor imports. So that's always the worry. So far the news on the tariffs. The news on tariffs so far, the Franken and Venture said there's actually no major shift in orders. So the customers actually haven't really put back their orders or cut back orders. But the one company that's getting hit the most, like what Miao mentioned, has been Yang Zhejiang. So I think Yang Zhejiang is almost like a profit warning that they were making. So they only secured like 300 million of orders up to May. A year ago, it was 3.3 billion. So the order secured is down 90%. And they changed, I don't know, maybe changed the goalpost. Their 6 billion target is more like capacity rather than a target. So they kind of said that this 6 billion doesn't mean they actually can achieve it. It's more like something they want to push the salespeople to do. And not expecting many orders this year, as the ship owners are actually waiting adopt a wait and see approach, especially there's a lot of orders already of container ships. So in terms of the events to monitor, I guess the key one to watch this week is going to be Nvidia and of course C-Trim results. So in terms of our webinars, it's open to anyone. Next slide. So just last two slides for me. I have two things on Phillip on the ground. So we had Franken results. They had a briefing. So Franken, for those who may not know, is basically a semiconductor equipment maker. Front end, they also make equipment for hard disk drive, medical instrumentation. The earnings was relatively strong. I think it was up 12%. They don't give a profit, but semiconductor revenue grew 34%. So in terms of the tariffs, they say that the customers basically status quo. I mean, they didn't really cancel. They just left it as it is. About 9% of their revenue goes to the US. And any tariff the customers will bear. And the other good news is that although there are tariffs, they are still working on new articles. New articles means new projects, new products. So that is still going on. So there's still, and their utilization rate is 60%. So the key one is the lithograph, which is of course ASML. So the good thing for Franken is that they're working on the latest ASML machine, the EXENA machine, which is so new right now that it's still technically like on trial and being trial used in the wafer fabs, like TSMC. And it will slowly be adopted because it's the cutting edge lithography. And of course, the good thing is that Franken is supplying to a customer which is a virtual monopoly in lithography. The one downside for Franken is the capex. So they need to consolidate all their sites, I think 3 sites in Singapore, into one big site in Singapore, and that might cost them 40 to 60 million capex. And there will be, of course, when you build capacity, there's going to be depreciation, more headcount costs. So I think that's going to weigh down on them. You probably only see it maybe next year, I guess. And they're probably going to borrow money to fund this. So in terms of outlook, I think you're still going to see stable demand from them. If you look on the chart on the left, if you just take the last 12 months, you can see that Franken's revenue continues to build up slowly. The blue bars you see here is the last 12 months. So that slowly continues to grow. And they're coming off the bottom in 2023. So in terms of our own comments, we don't have coverage, but we think you'll still grow at low teens. Because they got one major strong customer, and the valuations are attractive. I know about 12 times PE. If you just look at if you assume the profit now is annualized. Next slide. Okay, the last one. So we got some who asked about First Resources. We couldn't do last. So First Resources is a plantation company based out of Indonesia. They also have oleochemicals, biodiesel. So the earnings was very strong, about up 75%, because it was both this duet thing, the most powerful thing. You got like production up 15% and selling prices were up, I think like 40%, I think, or so. So the production was strong, although they are guiding 0 to 5 because they did the replanting. In terms of the impact of the tariffs, I think US is not a big consumer. The whole palm oil market about 80 million roughly, then the US is only 1 million. They don't sell anything to the US. But the one negative is that if you look at the palm oil price, since the 2nd of April, the palm oil prices are down almost 18%. Because there's a lot of panic selling, because there's a lot of inventory and then people start to just dump because production is strong. The other big news over palm oil is about what the Indonesian government wants to do with so-called plantation land that they deem illegal. Most likely, there's no news right now. Most likely, they might fine plantation companies. The problem in Indonesia is there are multiple authorities that approve the land. So the Department of Agriculture can approve, local government can approve, provincial government can approve, village head also can approve. So everyone can just approve the land. So you're not sure who actually. So that's the whole issue with the ownership of land in Indonesia, especially plantation land. They make acquisition. So the good thing for them is that they have a new biodiesel plant end 2024. In terms of the palm oil outlook, I think they think the prices will just be stable around these levels because production is rising both in Indonesia and Malaysia, and also one thing, the demand is coming back in from China and Malaysia because they are trading back at a discount to soybean. So one thing that those who are in palm oil will always benchmark against soybean. So whenever it's a discount, then the demand will start to improve. So in terms of our comments, I think we think we think First Resources it will outperform the other palm oil companies because they have this new huge biodiesel capacity where the profit is almost secured because the profit is based on the palm oil price plus $85 margin, which is given by the government. And the other benefit is a bit more technical. There is a byproduct or waste product called glycerin, and that the prices have started to shot up. I'm not particularly sure why, but the prices shot up, so they will get additional profit from doing biodiesel. Okay, I think I hand over to Darren. I think he just came in. Yeah, thanks everyone.
Thanks for so I'll run through CDL results, or rather the first quarter business update. So in the first quarter, they had some strong residential sales. So that's mainly from the launch of the Ori in January. So the property development sales surged in the first quarter by 155%. So that's the sales value, and 85% more units were sold as well year on year. So other projects continue to sell well, like Lumina Grand, the Busu Grand, the Mist, all having more than 80% already sold year to date, or rather to date. Yeah, and upcoming in the second half, they have a Zion Road Parcel A JV project, which is slated to be launched in the second half. Yeah, so their flagship Newport Residences is still TBC. Depending on market conditions, as that one is very high-end project. So the 60% ABSD on foreigners is still hurting the demand there. Yeah, so that one will still be pushed back for now, the Newport Residences. Yeah, so the hospitality portfolio, RevPAR remains stable. It continues to grow. It's grew by 1.2%. So going forward, we expect it to continue to grow by similar levels, low to mid single digit. For the first quarter specifically, the Singapore RevPAR was down by 16.8%. That's mainly from the Taylor Swift effect, because that one was the effect was too strong in March last year. So going forward, we also expect Singapore RevPAR to continue to increase though, by low to mid single digit as well. Only the first quarter we expected, or rather is down, mainly because of the Taylor Swift effect. So upcoming, there still are some strong, or rather still some major events like the World Aquatic Forum in the championships in Singapore as well. So this will help to continue to maintain, or rather improve RevPAR. So for the rest of the portfolio, US is down slightly. Some of the assets undergoing AEI. Yeah, rest of Asia, Australia, Asia, Europe help to drive the growth. So we see some 7% increase and 10% and such. Yeah, so for the negatives for CDL's first quarter update, the net gearing remains very high, so 72%. Increase another 0.3% from FY24's gearing. That's mainly due to the recent acquisitions. Like they paid off fully their stake in the Singtel Ltd, the mixed use development. Yeah, so the ICR also fell from 2.1 times to 1.4 times this quarter. But for the liquidity position, there's still a very strong liquidity position, 3.8 billion in cash and undrawn facilities. So there's no issue with liquidity or default risk for now, as their cash is still very strong on the balance sheet. Yeah, so for the outlook for them, the Singapore property remains resilient. So we've seen high take-up rates, and upcoming launches also, yeah, possibly will continue to be strong. The take-up rates for new launches. Capital recycling is the key for CDL now. So they're trying to monetize some of the assets, return some, hopefully return value to shareholders. And they do have several divestments in the pipeline. So we hope to hear some updates on that in the upcoming quarters on the divestment and asset monetization, and as well as definitely returning money to shareholders. And for them, the investment properties relatively resilient for now, like Singapore occupancy for both office and retail above 90%. The UK portfolio 81% increase quarter on quarter by a couple of basis points, but the weak investment property segment for them is in China still, where the office portfolio is only 52% occupied. So the demand there is very weak, and rents are so declining. So there's China still remains very, very challenging. Yeah, so for the first quarter, no change to our TP and our buy recommendation. Yeah, so $6.02 our target price. Yeah, next slide, please. Yeah, so move on to our REIT monthly. So after talking to most REITs, the first quarter update, where most mentioned that they do not have any or do not see any first order impact from the tariffs. So this is the share price performance for REITs year to date, as well as the 1 month performance in April. Yeah, we see year to date retail segment, especially the suburban side, remains the most resilient. So it's the only subsector that is up year to date. In fact, other than diversified is also CICT is in there. So which is also why the year to date performance is up. Yeah, so that's driven by really the resilient suburban portfolio, and we see the whole index is up 0.3%. It still remains very volatile, depending on of course, economic uncertainty like Trump and the interest rate outlook. So it really fluctuates depending on the expectations of interest rate cuts as well. So we've seen the share price really fling off, quite very volatile basically. Yeah, so we expect this to continue at least in the nearer term, where Trump keeps his on-off stance on tariff. Yeah, so that will definitely hurt or rather impact the REITs as well as the broader equity market as well for sure. Yeah, next slide please. Yeah, so this is the 10-year dividend yield spread. We see it continue to increase over the past 2 years. We also expect it to increase further going forward, especially with higher distribution yields, assuming the share price remains stable, as well as the fact that the government savings bond yield will continue to decline from interest rate cuts. So we see the 10-year yield in the right chart is down from the quarter-on-quarter average, as well as the fact that 3-month SORA is multi-year low. It's the lowest point since October 2022. Yeah, so that will also help to the REITs will basically continue to benefit from low interest rates, especially since the 3-month SORA, the base floating rate is already it's like 3-year low. Yeah, and going forward, basically, yeah, we just expect the dividend yield spread to continue to increase from widening from higher yield as well as the lower risk-free rate or the yield on the government bond. Yeah, next slide, please. Yeah, so this is the forward dividend yield continues to increase, and the price to NAV now is still below COVID-19 lows. So COVID-19 is about 0.8 or almost 0.9. So now it's at 0.87. So it's below that. And historically, we see over the past decade, every time when the REITs usually trade around 0.8, we see a rebound. So we think this is likely that this might be the case soon as well, where REITs will rebound from this price NAV of 0.8. On average, REITs usually trade about 1.03 times price to NAV. Yeah, for the index. Yeah, next slide, please. Yeah, so for the retail subsector, we still favor that the most. We see rental reversions remain the most resilient in the first quarter. We saw like positive 9% reversion all the way until 16-17%. So the split is around similar for both suburban and downtown. Suburban is high single digit to low teens. Yeah, and going forward, retail sales, the momentum, we expect it to continue to remain relatively strong. So about 20% above pre-COVID levels, and supported by things like the SG60 voucher, CDC voucher, and such, as well as in more international visitor arrivals, more events in Singapore. All this will likely boost retail sales, and the demand for space still remains strong. Like demand, especially coming from new concepts, F&B concepts from China, is still very strong. Yeah, so that will help to boost rents, and as well as the fact that occupancy cost is also trending below pre-COVID levels. So there is still room to increase rents. So we think rental outlook for this upcoming year is still strong for retail. Yeah, next slide, please. Yeah, so for the hotel RevPAR performance, hospitality performance, visitor arrivals improved year-on-year in April, and the March RevPAR was down quite significantly, 15% or almost 15%. That's mainly from a Taylor Swift effect in March 2024, because that was very significant. Like a lot of it was a C exclusive concert, so because of that, or rather Asia exclusive in Singapore. So because of that, many tourists. So RevPAR also spiked in that month, and we see our hotel occupancy also dropped quite significantly from last year. So as a result, RevPAR is down 14.4%. But we think this is more of a one-off for only for this month, or rather for the month of March. Going forward, we still expect the year-on-year RevPAR for the full year to increase by low to mid-single-digit levels. Yeah, and RevPAR is still is really 15% above pre-COVID levels, and visitor arrivals for the month of April is about 12% below pre-COVID levels, but as a whole for the full year, possibly we are expecting about a 95% return to pre-COVID levels for the full year. Yeah, and for the next slide, I have our coverage list. So there are a few movements, few changes in our rating and target price after the first quarter update, as well as some changes in our estimates for DPU as well. Yeah, so yeah, that's all for me. I think it's time to move to Q&A. Thanks.
Hi, thanks, Darren. I'll take some of the SATS question. Also, the TP of 4.8 adjusted down to 3.58, which is a big difference. Can you elaborate on this? Yeah, so we lower our target price to 3.58, primarily due to the fading e-commerce tailwind, which is the e-commerce from like China to the US. The component alone is contributing to around 5% of the group's revenue. And also US air cargo accounts for around like 25% of the group's total revenue. So with the shifting tariff landscape, such as like last Friday, they announced following SATS result, Trump is proposing new tariff on smartphones and also like EU imported products of up to 50%. This is like adding on further uncertainties. So we do believe essentially all the inventory restocking activity will be dampened from second quarter 26 onwards. Yeah, so there will be like no more supports from front loading activities. And also third quarter is usually supported by the festival shopping. Yeah, which is mainly from the e-commerce segment. Yeah, so with the cancellation of the de minimis, we do believe this catalyst will just be gone for SATS. And especially fourth quarter is typically seasonally weaker due to the post-festival shopping and also like shutdown of Chinese factories. Yeah, so overall, it's just like running out of catalyst for FY26 earnings. And we didn't really had a chance to lower the TP since the initiation of tariff in April. Yeah, that's why there's huge changes in the target price. So even though like FY25 result was pretty good, SATS announced a 30% payout ratio with DPS of 5 cents. And we believe the DPS is the payout ratio is very likely to sustain. Yeah, so translating to around like 4.7 DPS in FY26. Yeah, but we still like lower TP to 3.58 essentially because like all the cargo tailwind, which was the primary driver for the FY25's earnings growth. Yeah, so this catalyst will just remain highly uncertain. Yeah, hope it answers your question. And for Wilmar spreading itself too thin and not focus on their core business. What is the TP and time to accumulate or take profit? Yeah, so Wilmar is we view this as an effort of like reducing reliance on its core business, such as soy crushing and also palm refinery. Yeah, so downstreaming expansion is expected to drive margin improvements, and also like gain like mailing segment by broadening its consumer like product portfolio. So at the same time, like central kitchen model will support earnings as the utilization of their factory will increase. Yeah, so they do have like additional income from rental and also cross-selling of their products. And indeed, like yeah, but we don't have a target price for Wilma since we don't cover the company. Yeah, so the report we were sharing is mainly a set visit note. Yeah, so there's no TP for that. And will there be conflict of interest for Wilma by going downstreaming and compete with their customers? Yeah, so indeed by going downstream, they will be competing with their customers, and they will have like better advantages since they basically dominate the upper supply chain. Yeah, so but considering like Chinese market, especially like Chinese consumer stable products market is very big. Yeah, so we believe there is enough market share for both like Wilma and also their own customers. Yeah, so they do have a special product line for B2B and also B2C. So the product is different. For example, like the soya milk powder they supply, which is B2B business. Yeah, so all the soya milk in KFC in China is supplied by YKA, and they have a different kind of like product for B2C for the soya milk powder products. Yeah, so usually like B2C products has better margin compared to B2B. Yeah, hope it answers your question.
Yeah,
Oh.
anyway, for Wilma, they are going to central kitchen because that is the trend. I think more and more restaurants are industrializing, and where in the restaurants there'll be less cooking, more preparation. So most of the preparation can be done at the central kitchen. Then the chef, I don't know, he just kind of mix things up. So this is the way forward to industrial. The second thing is also the reason why they're going to all this more branded is to tap on their existing network. So they're always very proud of the distribution network that they have. So what they want to do, last time they just did edible oil, so now they're doing soya sauce, they're not doing flour. So they just want to add more and more to the distribution, which is only logical. I mean, because they're going to go to all these so-called distribution points, so they can distribute more and more items. So I wouldn't say it's cannibalizing, it's more like an extension of the business. And central kitchen is a new growth area of industrialization and more ready-to-eat meals. I mean, that's the way forward.
Yeah, thanks, Paul. Yeah, I'll move on to another SATS question. Can you comment on the SATS performance and future outlook, with the tariff impact? Yeah, so since like 5% of the group's revenue is exposed to Chinese e-commerce, export to the US, we do believe the cancellation of the de minimis exemption will hurt this kind of like demand. But SATS in the near term, SATS do say like demand from China to Europe to Middle East to Africa. So yeah, they are backfilling of the volume of the order which has been canceled by like Chinese to US e-commerce players. Yeah, and there's also like front loading activities for automotive parts. And even though like with $100 per peso of the flat fee charged by US tariff, made in China products continue to be very like very price competitive compared to made in US products. Since the typical price is around like $5 to $50, yeah, for the Chinese e-commerce such as on Shein or Temu. Yeah, so there will still be demand for Chinese e-commerce. And for FY26, we believe PetMe Catalyst is likely to come from the food solution segment, especially with the increasing demand for the ready-to-eat and also fresh frozen products in China and Southeast Asia. Yeah, so we are penciling in a 3% decline for their gateway service revenue. At the same time, we're increasing a PetMe assumption for like around like 7% for their food solution revenue segment. Yeah, hope it answers your question. And there's a question for Sungtech. Can you comment on Sungtech both retail and office portfolio? Is it a buy now? Yeah, so for Sungtech, rental reversion for its retail segment will still be resilient. We are anticipating like high single digit rental reversion for retail, and also a high single digit, mid to high single digit rental reversion for its office segment. However, the divestment of their strata units, the pace of the divestment is likely to slow down for Sungtech. So if I remember correctly, in 2023, they managed to divest 96 million of the strata units. And last year, they managed to divest 56 million of the strata units. But this year, we believe the pace will slow down. So probably the divestment amount should be less than 50 million, yeah, due to the tariff issue. And also like a majority of the buyer owner occupiers, so they prefer the currently available space. But currently Suntec office is like 96% occupied. Yeah, so they don't really have that space to use immediately since the lease is not like terminated. And also they prefer smaller size. Yeah, but the smaller scale is like pretty much limited in Suntec office. Yeah, we still have a buy recommendation. Yeah, essentially, Singapore portfolio remain resilient. Yeah, it's just Australia side remain the drag for Suntec rate. Since they're taking longer than expected to backfilling the Melbourne office. Yeah, hope it answers your question. I'll hand over to the rest of my colleagues. Thank you.
Yeah, thanks, Mel. Yeah, maybe I'll just take this one on the banks. Let me read the question out. Yeah, from Ian. Good question here. It's asking, do we expect further downsides on the Singapore banks with lower profitability on short-term interest rates? Yeah, so I think what you're trying to say is, with the short-term interest rates declining, whether this will affect the profitability of the banks. Yeah, for sure. If you look at the top line figures like net interest income and net interest margins, the interest rates decline definitely do have this immediate or quite direct impact on the net interest margins, because the loan yields will start to decline, because majority of the banks do floating rates. So once the rates go down, yields will also go down. But the other factor, that is what is mostly in the news and what people are talking about. But I think another sort of factor that is really affected by rates would be the current account savings accounts ratio. Right, this is something that's not really spoken about. It's a bit harder to understand. So this is the current account, or money that the banks have a lot of. These are what you call deposits, right? So when rates do come down, your fixed deposits will also be affected, and all those fixed deposits that you had maybe 1 or 2 years ago will start to expire, and you will be finding a new place to put them in. So to simplify it, you basically can't put it back. You won't put it back into a fixed deposit because the rates are so low, and it'll just flow back into your current account, fixed account, all your current accounts like the DBS multiplier, UOB1 account. And then these have very, very low interest rates for the banks, right? They are paying very low rates for these banks. I think it's very close to zero if you're looking at an average rate. So this is as good as free funding for the banks. And what they can do with this money or excess money that they now have is to either put it back into loan growth, or they can put it back into sort of longer tenure interest earning assets, and this will help to bump up the net interest income. So this is what the banks have been doing so far, and that's how they have been managing to balance their net interest income, although net interest margins have been declining. And that from the data we have seen in the past few months is that the CASA ratio, or this current account savings account ratio, has been steadily increasing. It's now above 19%. It's always been holding around mid 18% for the last year or two, right? And now it's above 19%. So it shows that this flow is really going it's all these fixed deposits are expiring and they're really going back into your current account, savings account, which is beneficial for the banks because it will lower their funding costs. So while their loan yields have gone down, but funding costs will also go down as well. And they're also doing many things like lowering interest rates. I think that would have been affecting almost all of us here, right? Where they lower all the interest rates for their for their one account, the OCBC 360. Yeah, they've actually been lowering the rates consistently, so that will also lower their funding costs further. Yeah, and on top of that, they're also giving the new fixed deposits that you open now will be extremely low. And there's two ways it will boost. I spoke about the net interest income, but this also move a lot of these funds into fee income, right? I think the banks, the what they're thinking now is, okay, loans are a bit slow, right? Net interest margins are not as attractive, so they will try to push a lot of these money excess deposits into fee income, which is why you may or may not have had more calls now from the banks asking you to do some wealth management product or some investment product with them. Yeah, so that is what they're actually focusing now, is on fee income growth rather than the traditional loans and net interest income, where in the good times like 2 years ago they could just easily get like 4% kind of net interest margins. Yeah, so that's overall. Talking more about whether there's any upside, I think the main upside for the banks now would be the fact that they have committed to their capital return initiatives, and they will continue to give. And just to address some worries out there, whether or not this is a bit too a rash decision by the banks, whether or not they should hold more capital. I believe that the banks already have excess capital that they have set aside, right, in terms of their management overlay and their general provisions, and they're actually building up more on that. And they do have a huge excess. DBS has around 2.6 billion of management overlay, which they have held since the COVID times until now, and they haven't really released a lot of it, right? So there's this huge bunch in case of a provisioning cycle. If more loans go into NPL than they expect, they can release some of this out. Secondly, if you look at their capital ratios, their CET1 is very high, right? And it's, even if they release all this, they already set aside their money for your extra dividends, for the share buybacks. Even after they have released this, if earnings come in flat, they will still continue to accrue capital, right? And it will still add into their CET and into their capital ratios. So we believe that they do have ample space to play with, and it's even possible that they could further extend this capital return initiatives. But of course, now with this macroeconomic uncertainty, they won't promise anything. They're just sticking to what they have said, right? Which is already quite good, right? And I think after it ends, then we can see how the macroeconomic situation is like, and then they would just give us a new update on whether or not they want to further continue with this capital return initiatives in order to get their CET1 back down to a more optimal level. So I think overall, but we are still expecting the bank's earnings will come in quite flat, at least for the rest of this year. From the first quarter results, what we are getting, what we are expecting and what we are feeling from the banks and what they're doing is that even if their earnings come in higher year on year, they will just take that excess and then they'll put it back into general provisions, just to buffer up their provisions coverage, right? And they're aiming that the earnings will come in at least stable year on year compared to 2024, right? So 2025, I think earnings will be relatively flat across the board for all three banks. Yeah, but dividends wise will still be quite high because they are giving that additional payout. Yeah, I hope that is a detailed enough answer to your question. Yeah, okay. There's one more about the GE. Any updates on the GE saga? Is there light at the end of the tunnel anytime soon? I don't think there's much light at the end of the tunnel anytime soon for now. What the OCBC CEO did say was that, as usual, they don't really say much. But what they did say this time was that they are not counting anything out. And they're also sort of pushing a bit of the responsibility to GE to make that decision. But it's quite funny because they own around 90% of GE. Yeah, but they are not trying to take on the responsibility as much. They're saying that it's GE's problem and that they have to settle it, but they're also not counting out the fact that they could give a higher offer. Yeah, but just to take note that those shareholders that already accepted the previous offer, the VGO that they gave previously, right? You won't be able to get the new, if there is a new offer, you won't be able to get that new offer. There won't be a like sort of increase in your offer that you already accepted. Yeah. So this is really only for those that are holding out basically. And I think the main issue would be that that one family that has quite a big portion of GE, and they're refusing to sell unless they get a better price, you know. And I think they are still in talks with them. So it really boils down to how well they can, you know, hold the discussion. Yeah, no, GE is not tradable now. I think it's still suspended. Yeah, okay, there's one on Tesla. Yeah, I covered Tesla as well. Yeah, any thoughts on the key driver for recent price surge of Tesla? Is it purely technical? It's rather head-scratching, especially when the EV sales collapsing everywhere and losing market share to BYD. Yeah, exactly. So we do have a sell call on Tesla. I think that this is a bit, you know, there's some talk going on that Tesla is a bit of a meme stock if you look at it, right? It may be in the Max 7, but it's a bit of a meme stock because the drivers for Tesla when the share price goes up or goes down, nothing to do with the fundamentals, right? You know, you can see that their sales collapse, you know, deliveries collapse, you know, everything collapse. But then their share price actually does the inverse. And it's really due to whatever is surrounding Elon Musk, right? Their founder, no, not their CEO, right? And the main key person. So if Elon says something like he's going to concentrate more on Tesla, right, and move away from the Doge, right, the government efficiency, and you know the certain investors will assume that, oh yes, that's a good sign that he's coming back. But he didn't really set it in stone that he is coming back. He just gave an indication that he will be coming back. So that could be one of the possible, you know, key drivers. There's a lot of things that, you know, that doesn't have to do with the figures that they actually give out, like sales, average selling prices, you know, or the market share. Yeah, the main worry is market share is really collapsing against not just BYD, but a lot of the other Chinese EV players, and also even in the US, right? If you look at it, the US companies like I think Ford, they're also coming out with EVs, right? And they're also taking market share away from Tesla. In China, it's even worse because you have the Chinese EVs, and you know they are also taking market share away from Tesla. In Europe, it's also the similar story where Tesla is losing market share. I think it's partly due to the branding, you know, and Elon Musk as well. People do not want to associate with him because of his close association with Trump. So they're just losing market share everywhere. Sales have been very, very dismal, right? So, but the share price has been going up, and it's really a head scratcher as well for me. So we do stick with our sell call. Yeah, I have just stuck with it. You know, I don't believe that, you know, based on the fundamentals at least, that the share price should be trading that high. Yeah, and I guess the next quarter's deliveries, you know, and production numbers will really show if, you know, if it's a continued downspin, and if they have even tried to do anything to get back, get back from what they have in the very disastrous first quarter that they had. Okay, I think I'll hand it over. Wait, sorry, yeah, we don't cover XPeng. It's a very yeah, for XPeng, we don't cover the Chinese EVs, but you know, just based on what I understand from XPeng, it's more of a they are not a BYD competitor because they are really more high-end, right? They're more high-end EVs. If you look at their cars, right, they are not they're not the mass market kind. They're more expensive firstly, and they're also if you look at their cars, they really look very similar to a Tesla, right? Especially I think one of their models is a direct competitor to the Model Y, right? It looks very similar. Yeah. So for XPeng, I think they are more of a niche market. Yeah. Yeah. Okay. There's quite a lot suddenly that came in about the EV. Yeah, well, with BYD building more market share in EV sales, is it good to accumulate some? Yeah, we don't cover BYD also, but yeah, they are building market share in the EV sales. But I think the worry is whether or not, how much more they can go in China, whether or not they need to expand out of China, and what are the regulations surrounding outside China, whether or not they will clamp down on the Chinese EV makers. Right. In China, the growth is quite steady, also partly because of the sort of the government subsidies and help that has been giving. That's why you see this, double-digit growth for many months, right, in China in EV sales, right? So whether or not, how far more that will continue, and whether or not they can expand out of China into, I think more importantly, more into Europe. I think US is a bit out of the question now, especially with Trump's administration. Yeah, but more into Europe and I guess into Asia Pacific, so ASEAN and Asia, the rest of Asia. Yeah. Let me just quickly go through all these. Impact of EV battery makers, with the increase in EV market share, would these EV battery makers be susceptible to Trump tariffs? Yeah, for sure. The China EV battery makers, they don't just make it for Chinese companies, they make it for Tesla as well, right? And if there's if the if all these US companies, they are taking it from these Chinese, they would be susceptible to Trump tariffs. But I think majority of their sales is still to the Chinese markets, and to outside of the US as well. So it's a bit hard to say that they would definitely take a hit. I think their main customer would be Tesla, because they still source their batteries from China. Yeah, the rest a bit hard for me to explain, yeah, because we don't really cover. Maybe NIO, I'll just do one last one about NIO. Yeah, I think NIO is quite, it's also on the higher priced end, right? Which is why they are not taking as much market share as compared to BYD, because they are a bit more pricey, right? If you're paying almost double the price, close to double the price, right, or 50% more for a car that does the same thing, just that maybe you get the extra. I think NIO has this special function where you can swap the battery out, right, which is very convenient. Yeah, instead of charging the car, you can just swap into a new battery, and it takes, like, I think 5 to 10 minutes. So that's the only difference about NIO, but you're paying a lot more for that particular function and ability. So I guess the mass market would still be wanting to buy a BYD or even a Xiaomi, right, where the price is just right for them. Whereas for NIO, I think they are still trying to catch that other market, and if they can bring that price down, then they would be able to go more mass market instead of just the premium segment. Yeah, okay. I think that's all I can do for the EV. I'll hand it over to the rest of my colleagues. Thanks.
Thanks, Glenn. I'll take on some questions. So there's a question: what is the business of BRC Asia? Yeah, so BRC Asia provides steel products for construction. So for example, like your steel wire mesh, your steel rebars. And what is the raw material for BRC Asia, and where do they source this raw material from? Yeah, so the raw material is actually just steel rebar. So sometimes they will cut and bend the steel and into various forms for the construction. Yeah, so there's a follow-up question: what is the final product and who are their customers? Yeah, so in construction, how is steel being used, right? You can just imagine it being like a concrete slab. Within the concrete slab itself, you still need the structure itself. Yeah, so the steel forms the structure for the concrete slab, and then they will pour in the concrete in order to form this kind of concrete blocks. So these kind of blocks are being used in your walls, your ceiling, your floors. Yeah, so their customers are for example, main contractors, subcontractors, and they have a 65% market share in the entire construction industry in Singapore. So almost every project needs steel. So yeah, their customers are mainly the subcontractors and main contractors of these projects. Follow-up question: are their product prices controlled by an agreement, or do they sell with spot prices? Yeah, so mainly they take in orders, and the products are being priced through contractual agreements. So for example, the contract can state over the course of 2 years, I want this amount of steel at X price. Yeah, so it's being it's mainly through contractual agreements. That's why they also have the order book itself. So generally it will still be in line with the spot prices lah. So if the spot prices go up, generally they are being sold at a higher prices, and when it comes down, vice versa. Yeah, hopefully that gives a better insight. There's one more question for me. For Centurion, do you expect more upside in view of exodus of foreign students from US universities, for example, Harvard to universities in Australia? Yeah. I mean, most recently with the Trump's administration coming up and the uncertainty in the US, I think definitely that it may present more demand in terms of foreign students to Australia itself. However, Centurion has not provided an official guidance on whether this will present more upside in terms of guidance, and there is still the shortage still persists in Australia. And I think this phenomenon of decreasing demand to US universities has been around since before COVID. And then during COVID, it accelerated the process even more. Now more foreign students are going more to Australia universities. So it's not like a sudden change of trend itself. Like this trend has been on for the past few years. So in terms of upside, there won't be like a major upside in today's environment. Yeah. Yeah, I think that's all from my end. Thanks.
I'll answer the Apple question. Any thoughts on Apple, especially with Trump's threat on upping tariffs? Time to accumulate a set. So for their current level of tariff impact, they have guided for a $900 million for the next quarter. And they also said that the impact for the further quarters will be higher. The third quarter is lower because they already did a lot of preemptive inventory management. So we estimated the impact on the future quarters is going to be around 1.5 billion US dollar on their COGS. So that's also going to weigh in on their gross margin. We expect it to shrink around 0.6 to 1.6%. They are having plans to invest in US for their operation. They're planning to invest around 500 billion US dollar over the next 4 years, but that is going to be something long term. So in the short term, if Trump continued to up the tariff, pretty much they're defenseless on that. So overall, we have a neutral rating right now. Just trying to see how it plays out. Yeah, so hope that answers your question. I'll pass my time to, I don't know, my colleagues.
Let me take a quick one. Please comment on ASR logos and MLT price decline this year. Any turnaround? Yeah, so both over the past few quarters not performing so well, but ESR is starting to see some turnaround with lower interest costs and contributions starting from the acquisitions. So they already saw DPU year-on-year increase in the first quarter. So likely this year, upcoming we expect more DPU year-on-year increases. So ESR, the recovery is starting to turn around. MLT, the China side still remains weak, but the performance is for the past quarter is getting less weak than before. So things are slightly improving, but of course the impact of trade tensions and tariffs will continue to impact them. Like there's a lot of uncertainty in the logistics sector, like global supply chain, so that will continue to impact them. Yeah, but they are trading at a cheap discount to valuation, so it is possible that the share price can turn around. Yeah, but it's still pending on, of course, the headwinds that are ongoing. Yeah, thanks. That's all.
Yeah, thanks, Darren. Let's clear some the next 5 minutes so that we can do the technicals. Good morning. Yeah, good morning, CK. Singtel keeps selling their assets. With the disposal of these assets, what is the impact to the balance sheet? What are the plans for future growth? Yeah, okay. So for Singtel, actually the balance sheet has improved a bit, these asset sales. But in terms of the share price, propping up the share price, I mean, you cannot be keep on selling assets. After a certain time, there's not much assets left to sell. But I think in the next 1-2 years is still fine. The impact on the balance sheet actually is improved because they're getting cash and paring down the debt. The plans for future growth, there's actually three parts of the future growth that they're trying to look at. Of course, mobile is already matured. So for countries like India, Thailand, Indonesia, the growth is actually broadband, fiber broadband. I know like our fiber broadband, the penetration there is like low single digit or even low teens. So that is the future growth. From the emerging markets. The second future growth for emerging markets is also from the data center. From moving into enterprise business. So if you look at the evolution of Singtel, Singtel started as a fixed line, then go to mobile, then they started to move into IT and enterprise. So this is what they're trying to replicate for their associates, these emerging countries. And the third growth area for them is the data center business. So they are opening a new data center. To us, they're opening in Thailand. So these are the three growth drivers for them. In the meantime, the growth driver for Singapore is just to cut costs. So I think they cut the headcount. I don't have the number of me, like 10, 12%. So they really, so that's the way to growth for Singapore in the near term. Yeah. Okay. So please comment on CSE and Venture Corp. Okay. So for CSE, I think we did mention last week. I think first half will be weak. So the second quarter also, in part, there was a bit of disruption. I think when the new administration took over, as you know, I think at least half or more of their business comes from the US. So that part was disrupted. The order flows was disrupted. But they think that the recovery will come in the second half. In terms of venture, I think venture looks interesting. I think the yield now is talking about 7%, and they got 1.3 billion to make sure they give you this yield. So they're virtually, to be fair to management, although the results is bad, I think 2025 they're virtually guiding a very weak year. They are paying almost 90% payout ratio. They are really paying out everything as dividends. That 75 cents, which they will maintain. The interesting thing to watch for venture is in the second half. So one of the big products that they have is this heated cigarette called IQOS. So there is a new version called the Lumina, and for that, Philip Morris International is applying for approved. Then this stock will fly because this is apparently one of their big customers. So in a way, venture at these levels, 11, maybe you can keep it, but don't expect any strong results. But you are getting at least a 7% yield until you wait for this particular event. So that is the prognosis. As an analyst, we cannot recommend this because we do not know what's the timeline. Then we just keep telling everyone, oh, it's coming, it's coming. Then of course we can for analysts sometimes have a difficulty because we have no visibility when this major launch will happen. So that's why we tend to keep it as a whole and hold back. But of course, 7% yield is very attractive, at least for venture. For Sembcorp, so Sembcorp, our forecast is I think 7 or maybe high single digit kind of growth. The growth will come from the renewables, and also growth will come from the renewables that they roll out, especially in India. That means all the wind farm, solar that they do. Second one is the 30% acquisition of Senoko Power that they acquired. I think Sembcorp is just that the growth outlook isn't that spectacular. The only thing is maybe in FY26 when their new power plant in Singapore turns on, then I think you get this big kicker. Until then, for us, actually, we prefer CapitaCorp because they have a new plant coming second half of this year or end of this year. They have the new Keppel Bay Tower to contribute earnings. And the third one, gosh, this is a slip of my hand. And also they have some asset monetization coming, including possible, I don't know, M1 sale, disposing of some of the REITs. So for us, Keppel looks more interesting in that sense. There's a much more catalyst happening for Keppel, in our opinion, than Sembcorp. Our target price for Sembcorp is 710. Concerning SBS Transit, but the dividend payout be impacted badly this year because of the loss of Jurong West and on September 2024, and chance that SBS Transit will win the Tampines Best Bus Package July, August this year. I think the Tampines one could be in April. I think it could have already been concluded already by this month. Okay, so the dividend payout, I think the ratio that I think if the earnings are down, I think they are not going to raise. There are no special dividends. So I think that if, like you said, the dividend will be impacted. So there is a risk for losing Tampines. They lost Jurong last year. The reason why we say that is that it seems to be that the authorities are moving away from negotiated contracts. That means I just chit-chat with you, negotiated to tender contracts. That means you actually have to bid. You have to actually compete. So directionally, it may seem that the authorities want to invite more competition into this segment. So this will be negative for SPS. And even if you win, if you are tendering, obviously your margins going to be affected. So I think the outlook is a bit more challenging for SPS Transit. I think that's my own view in terms of the bus packages. How about any update or status on MES looking for improving liquidity for? Oh, okay. So just to refresh everyone's memory, so MES has announced, thank you very much, they announced a 5 billion plan to inject money into the Singapore stock market. Apparently, the first round has already gone. So this is the second round of assessing which fund manager to farm out this 5 billion. Okay, so that's one part. So that is happening. We're not sure what's the date. Maybe third quarter the money could be declared. I don't know. I'm just guessing here. But the second thing is how much goes to small mid cap. Of course, that is our interest. Our own guess is it could be as much as 1 billion. I think this is purely guesswork. So if you look at what MES announced is that of that 5 billion, at the minimum 30%, which is 1.5 billion, will go into the Singapore market. The 70% could be go to regional mandate, but I don't think it'll be so low. I think at least half should go into the Singapore market, because this MES wants to give to funds that are dedicated to Singapore. But I think MES knows that not all, especially the big funds, which I think we don't really care. But anyway, the big funds always complain they cannot have a Singapore only mandate, because they one of the reasons is that MES, after giving you this 5 billion, they want you to grow the money, but it's hard to build a fund just on Singapore. So all the big funds will complain, I need Asian mandate or ASEAN mandate. So that's why they said that at the minimum 30%. So if you assume half 2.5 billion, they don't really say all must be go small cap. They just say non-index. So if you take those even above 1 billion, there's very few companies that is above, sadly in Singapore, above more than 1 billion. So it's definitely a positive. I mean, just to cut the story short, it's definitely going to be a positive for the Singapore market, small mid cap. The timing, I'm not sure. My guess is third quarter. Yeah, but anyway, it's a very long answer. Any new target price for Genting after recent results, taking into account the new offering? We don't have a target price. We don't cover. I think I can ask Zane, but I'm not sure what new offering. If you're referring to the new offerings, the new theme parks, I don't think it's going to move the market. I think the new theme parks, what do you call it? The new Minion Land. I do not know. People travel all the way here to go ride Minion Land. Lady Gaga, yeah, but come all the way here to go and ride the Minion Land. I'm not sure. My view is that the picture Genting is facing pressure because there are less and less tourists coming, especially Chinese tourists. They are down for almost the past 3 months. So this is going to hurt Genting. So the demand, and secondly, the competition with Marina Bay Sands, they still cannot compete with Marina Bay Sands. So they continue to lose market share to Marina Bay Sands. So that one cannot change. Even you put 1 million land, I don't think people go rush there to go and gamble because got million land. So that's my worry for Genting is the demand for gaming coming down, and also the loss of market share. Paul, any news for the MES shortlisting fund managers? What do you think? Which counters? Which counters? I think the immediate one would be those 1 billion and above. But even First Resources could be one of those. I'm just thinking aloud because my general view is the fund managers may not go down to the very, very small cap stock because they may not know. So they might buy the top tier. But I think even then that is good enough. Because if you buy that, those stocks start to rally, right? Then it will have this kind of virtual cycle because the valuations will go up. Then a lot of people make money. The usual thing, people make money on those mid caps. Then they will start to move down to small caps. Then you get this cycle. How long it lasts, I do not know. But at least if you're buying small mid caps, that's why we are overweight small mid caps, because you know this money is coming down better than CDC voucher. So it's coming. So just get ready for it. And I think the conspiracy theory is that that's why you see a lot of privatizations. I don't know whether how true this is, but I think if you're the owner and you want to privatize cheap, but at the same time you know this money is coming in, might impact your ability to privatize cheaply. So that could be one trigger why you see so many privatization recently. I don't know, this is a conspiracy. I don't have any proof to this. What's your outlook on alternative assets, other balls? Okay, silver is easy. The silver is not a precious metal. There's more industrial use, so that one's a bit easier. For crypto, I really don't know. I'm really not a big advocate. So for us, I think gold still stands out because if you look at the performance, gold is almost like has been recently been a very good hedge. It's like when the US equities come down, then gold goes up. So I guess it's still a useful hedge in that sense. Paul, which are the likely fund managers which will be selected for the EQDP to work with, is called, and will companies like SBS Transit or UMS integration benefit? I'm not sure SBS Transit because the volume is so thin, but I think UMS integration will definitely benefit in one way or another, because they are quite well known. The liquidity is quite good, and they are very well covered. I don't think any analyst cover SBS Transit, if I don't know. So what will happen is that fund managers will definitely go to the sell side and ask, okay, give me your conviction list. That means what are your best small mid cap ideas? Because most of these fund managers may not be familiar. So from them, they will pick. So that UMS is well covered. I don't think SBS Transit. I mean, that's my own view. That's the usual journey of the fund manager. They'll look at liquidity, look at what is being covered, because otherwise they have to go and visit all these companies which they are not sure, and they may not even pass the investment committee because they will normally ask, how do you know about this company and what's your priority? A lot of Hong Kong Sunny Optical, we're not sure. CATL, maybe you can ask Glenn. On Singtel, sale of land lease has been reflected in the current share price? Yeah. They've already received 1.3 billion from the sale. It's already reflected in the second half results. So what they did is they injected Comcentre into a JV with Lendlease, which Lendlease will inject money, then consider a sale to this joint venture, and they made 1.4 billion. Not only that, they still have a stake in this joint venture, and of course they will move their office back into Comcentre, and they will also collect rent from this mixed development of office and retail. So it's like a super win-win. Yeah. Is Franken well covered? Yeah, Franken is well covered. yeah, Franken is well covered. I mean, like, yeah. So these are definitely those stocks that will move. Yeah. I mean, not move. I mean, that will be on the radar screen at the very best. Yeah. So thanks for the questions. I'm not sure. A lot of these are Hong Kong stocks. I'm not familiar with them. Maybe Glenn, if you want to take down. If not, you can hand it to Zane first.
Yeah, maybe I'll
Thanks.
just
Okay.
let me do a quick one. Yeah, the CATL. Yeah, so it's a bit hard for me to comment on this because but I think the main reason, I'll just answer one of them, I guess. Why it trended down so quickly after the IPO. Multiple factors. It could be some value, some profit taking, of course, from the initial investors, and also certain of the macroeconomic uncertainties, because they are the Tesla's EV battery supplier, right? So if Tesla is affected in terms of their sales, right, they will definitely take less from batteries as well, right? So overall, it could have an impact on CATL's demand and revenue if Tesla's demand slows as well, right? So that's one of the possible reasons why there's some pullback after the initial increase. And so if you couple all these uncertainties, and its dependence on Tesla, I think that's the reason why the share price sort of corrected slightly. But of course, it's still, I think, above what it IPO'd at, so it's still slightly above it. Yeah. So let me go and I think wait for a while to see how it goes, and also I'll find out more information on CATL. I can give an update in the next next week's briefing. Yeah. I hand it over to you, Zane, for the Maybe Zain can also do some technicals on it, but I think it's too short to do anything. Yeah, okay. Zain, I hand it over to you. Thanks.
Okay, thanks, Glenn. Yeah, I'll move on to the technicals. So let me just share my screen. Yeah, so first question is on capital. I think for now it looks pretty sideways. Looks like nothing much is going on right now. So probably still, I think it'll be still quite range bound for the near term. Probably between 670 to about this 685 area. Yeah, for capital. Then next one is on Bank of China. So Bank of China also, I think it's the current this up wave is still intact. I think it's just turning a bit sideways again. Just trading between like 460 to about 473. So it's still holding above this previous high. So I think it's still quite okay, but it's just turning sideways right now. Okay, next one is 103. So that's CK Infrastructure Holdings. Yeah, so I think for this I think it's still facing I think there's still a bit of resistance coming from this trend line over here. So I think need to just still pretty sideways. But if you can hold this support around close to 49.60, then I think there could be a chance for a breakout. Yeah. So I think it's still quite sideways. But if you can hold all this higher low, then there could be a chance for a breakout above these key levels of $51. Okay, next one is 998, which is Alibaba. Yeah, so Alibaba, I think after the earnings that was kept down, I think it's still looking pretty weak. Still trending for now. It's trending below the blue line of the 5-day MA, which previously was holding above. Yeah, until the break of this channel. Yeah. So currently still facing resistance right around there, which is around $120, $120.20. Then some support is coming in around $170.50. So I think at most probably sideways for now. But if it does break this swing low around $117.50, then it could head out to the next support area, which is around 112 to about 115 area. Yeah. So Alibaba probably sideways right now at best. Next one is 9618 JD. So JD for now also pretty sideways. Yeah, so overall, generally between the 125 to 146, the range over here, but seeing lower highs along the way, and if it does break below this swing low of 129, then we could see a retest of the key support closer to 126. Yeah, so I think still not much momentum right now. Facing resistance for the short-term moving averages as well. Okay, next one is on AIMS APAC REIT. Yeah, so for AIMS APAC, I think for now it's still just gradually trending upwards. Good thing is still above this resistance of 125. There could be some resistance close to 129, 130. So for now, probably we could see a bit of a sideways kind of action. Yeah, but between 125 to about 130 around there. And generally also not much volatility for this REIT as well. So we could just see some kind of sideways action. And next one is Parkway Life REIT. Parkway Life, very, very clear defined sideways trend for now. So the very strong support should be coming in from this uptrend channel support over here. That's closer to about $4. And for now, there's a lot of resistance still at around 425, which was this swing high over here. So very, very much still sideways right now for Parkway Life. Next one, Elite UK REITs. Okay, I think Elite, yeah, overall it's still range bound. The long term is it's an uptrend. So for now, just we tested around this 32.5 cents recently, and I think for now the support will probably be around 30 cents, 30.5 cents level. So we might see some consolidation again over here right now. Yeah, it's just the retest of this resistance recently. The next one, this question is on SATS. Yeah, so for SATS, I think after the results, there was a gap up, and for now it's still in terms of the short-term moving averages, it's still trending along holding above this 5 and 10-day moving averages nicely, the blue and the red lines. So this is still finding support around the $3 mark, and for now maybe a bit of a sideways consolidation, some resistance around 305, 306. But I think if there could be a chance of a break since it tested around 2 times previously. So if it can close somewhere around here, this resistance and carry on momentum, I think there could be some further upside, maybe towards the next resistance level around 315, around there, then followed by around 323. Next one, Singtel. Yeah, Singtel, I think yeah, after the results there was a gap up, but then hit around the $4 resistance, and they started to pull back a bit. So I think for short term wise, we might see some pullback. So if it does, for now the support is around this $3.80, $83.81 level, the 10 and 20-day MA level, as well as this was the previous horizontal level here. So this must hold. If not, we might see some further pullback in the short term, maybe to retest this strong support around 370, which has held as swing low twice now. So I think on the short term wise, it risen quite a lot as well. So we might see some range bound for range bound consolidation in the short term. The next one is on Sembcorp Industries. Yeah, Sembcorp, I think overall still an uptrend over here. In the short term wise, we have seen a very long range consolidation since end of April. Good thing though, I think it's still holding above this 644 previous resistance as holding a support. So there's still a bullish sign, just consolidating sideways with resistance around 670. So I think still positive. Might still see some sideways consolidation, but I think more towards upside bias. If you can break above 670, then we could see a chance to we could see the counter extend its uptrend to maybe retest this trendline resistance. So let me see. That's somewhere closer to about $7. So if it can break above 670. Next one, WeHe. Yeah, so for WeHe, I think short term wise, there's still some weakness. So since since the 47-cent resistance is been pulling back, also breaking below this 44 cents level, and see finding resistance for the 5 and 10-day moving averages. So I think that will still act as a resistance in the short term. We could see some further pullback. Perhaps towards the next support level, probably around the 38.5 cents, 39 cents. That will be the next support, which previously over here there was after it hit the swing low, then there was a bit of a consolidation before breaking outwards. Yeah, so I think we might see some further pullback continue for WeHe in the short term. Next one, Yang Shipbuilding. I think for now there's some weakness because price is again back below the short term moving averages. After the results update as well, Friday was down over here on increased volume. So currently holding at this horizontal support around $2.05 and $2.06. Yeah, so if this cannot hold, then we might see some further pullback to probably fill this gap as well as this previous horizontal resistance, close to about 195, 196 then. So I think short-term weakness likely to persist for Yangtze Jiangxi Building. Next one, Yangtze Jiang Financial. Yeah, Yangtze Jiang Financial, I think there's some the momentum has slowed down. So previously it was trading very nicely within this uptrend channel itself. But recently, I think last week it broke below this key 73 cents. So 73 cents I think is the key level because previously over here it was during the bull run in April. I think there was some consolidation, so supported into resistance over here. Then the breakdown of the channel as well as horizontal level, and it's below some of the moving averages as well. So I think we are probably I think probably you will see some consolidation at a lower range. So 69 cents now is now the support down here. Then resistance probably at 72 cents to 73 cents. So probably sideways consolidation within a lower range. Yeah. Next one is Shengsheng. Yeah, Shengsheng, I think for now looks like nothing much is going on. Just looks like a range consolidation right now. Yeah, between like 180 to 188. Yeah, so yeah, volume is also coming off right now. So I think just probably sideways. Next one, 5 TP CNMC gold mine. Okay, CNMC, I think going a bit sideways recently, but I think there's some renewed strength from this range consolidation recently. So it was holding around 39, close to around 40 cents. There was some resistance at around 43 cents, but today I think there's a bit of a gap up opening above it. So you can hold above this resistance. I think there could be a good chance of it going upwards towards like to retest this 47 cents swing high again. Since it looks like it's trying to break above this range consolidation, also above some of the short-term moving averages. Yeah, so I think there could be some short-term upside to retest this swing high again if you can hold the 43 cents level. Okay, next up, some questions on the REITs. So first one is MIT, Mapletree Industrial Trust. Yeah, so Mapletree Industrial Trust, I think it's a bit of a breakdown below the support, which is around 193. So also trending below some of the short-term moving averages. So this 193 likely to from resistance, a support-term resistance, and we could see some further pullback here to test maybe like the next good support, probably 188 and 185 next. Next one, Mapletree Logistics Trust. So this one also for now still sideways, holding support at 108. Resistance for now probably around close to like 111 and then 115. So I think could be quite sideways still, but lower highs. There's a bit of lower highs from 119 and then this 116. So we could see another lower high taking place around here because the overall trend is still weak. The next one, CICT, nothing much for now. Still very likely in the short term wise, we're seeing very sideways over here. I think the good support is still around $2 near this swing low, as well as we have this uptrend support line. Then resistance for now, it's above 208 to about 210. Yeah, so probably sideways consolidation since the double top was from around 3. Okay, then moving on to Escort, CapitaLand Escort Trust. Yeah, so for this also very sideways right now. The previous support at 86 cents turning from support ahead into resistance, but I think support for now probably is 84 cents. So yeah, very small candlesticks in terms of the size. So nothing much going on right now. I think just very sideways. Okay, next one, Suntec also just quite sideways right now. So I think for now resistance is around 116, then followed by around 119. Then support is around this 111, 112 level. So just still very sideways. Also very small candles and low volume since end of April. Okay, I'll move on to some of the Singapore banks. So first up, starting with DBS. For now, is just still consolidation, but I think still okay as long as it can hold above this recent swing low. That's around 43.75 around there. You can hold this level, then I think it could still continue a bit of range bound. And if it breaks above the resistance to form a higher, this 44.75, then you could see a retest of the highs at around 45.40. For UOB, it's weaker than DBS. It's just moving sideways, but good thing is still holding above this key level, which is around $35 psychological level, as well as this was a range resistance holding a support. So nothing much going on for now. Just $35, then resistance around 35.80. So just sideways. Yeah, but it must hold 35 for this sideways to continue. If not, we might see some pullback closer to 34. I also don't expect much in the near term to go upwards. So probably just range bound as well. Then for OCBC, I think quite similar to UOB. So just sideways as well. Resistance like holding above $16.30, and support is around close to $15.80 to $16. So it's very much sideways as well. So probably only DBS is the much stronger one compared to this UOB as well as OCBC. Okay, next one, some US counters, Nvidia. Yeah, so Nvidia, I think quite strong recently. Since it broke out of this downtrend channel resistance around 122. Yeah, so for now, I think looks like a bit of a sideways consolidation taking place, 128 to about 136. Yeah, so we might just see a bit of a range bound first. Then you can break over 136. The next key resistance probably around 143, 144. Okay. Next one, Amazon. Amazon, yeah, I think since the gap up on 12 May after the China-US stocks, just been sliding down a bit. I think there should be some support close to this 195 to 198 this area, because this was a breakout. There was a breakout of this key resistance over here at 193. Then I just pulling back over here for now. So we might see some support come in at this 197 and side. Then for now the resistance probably around 204, 205. So probably sideways, yeah, sideways a bit. For Microsoft, I think it's still holding quite well. So since the earnings gap up, it has been slowly trending upwards and still holding above this trend line resistance, as well as the 445 horizontal level break. Just finding a bit of resistance at 455. Yeah, so for now, it looks like a bit sideways going on. And a bit of in terms of short-term momentum start, it's also going under the 5 and 10-day move area. So we might see some slight pullback, but I think we'll likely still find support probably around 440 to 447 around there. So probably a bit of a sideways consolidation in the short term. The next one, Adobe, I think, yeah, Adobe for now since the break above this downtrend channel, also was also above this horizontal resistance 403, so we might see a retest coming in. That could act as a way of resistance and support. Yeah, so this 400 to 404 level, we might see some support for a bit of a bounce, but resistance for now is from 414 to 422. Yeah, so after that maybe it's a bit of a sideways consolidation. Okay, I think there's some question on the Hong Kong counter Sunny Optical. So I'll just look into the charts. Sunny Optical, I think there's likely to be still more weakness, I think, than upside ahead. Because since the breakdown over here, $83 price trending down, then previous support over here 72 turned to resistance. So overall now it's just probably in the range between $60 to about 70. So 60, this support, I think for now test might still hold a bit, but I expect a lower high bounce, probably around 63, 64 to face resistance around there. Then in the future, if it does break below again, then we might see to test 52, 53 again. Yeah, so overall, I think the trend is still more towards the downside for now. Yeah, so I think it's about 1 o'clock. So sorry, there's still quite a bit of a TA questions. But sorry, I need to take all of them now. But feel free to post them inside our poetry committee group, then I can answer it over there. Yeah, so I think I'll pause the TA for now. I'll hand back the time to my colleagues if there's anything to add on. Thanks.
Okay, thanks, Zane. So we answered most of the questions, and I think some of them are on Sunny Optical. Sorry, we don't, or Xpeng. Sorry, we don't really cover these Chinese stocks. Ours mainly US and Singapore. We'd like to thank everyone for your time and especially for your questions, and hope you have a wonderful week ahead. Thank you, everybody, and take care.